The next techniques in carrying out capital budgeting is what we refer to as accounting rate of return, ARR, and it's also known as return on investment or return on capital employed. It's an accounting technique to measure profit expected from an investment. So the formula is what? Is average annual profit all over, that is average after tax. So don't forget, after tax, if there is tax, you remove tax, all over initial investment multiplied by 100. That's the formula you can see on the screen. And from our question, if I should take you back to the question, what we have is an average annual profit. What's our profit? Look at it. We have profit of, what's our profit? Our profit for 10,000. Let's go back to the question and see properly. Let's read the question. Now the question says, if the cost 10 million, the cost is 10 million, 5 years, average value 5 million, the total, yes, no tax. Now annual profit after tax, let's go there. Annual profit is 18 minus 10 million. How do we get the 18? After tax, let's go back to it. So for that 5 years, the profit is not 18. The profit is not 18. We have 4, making 8 million, 10 million, profit is 30 million. So there was a problem in it. So it's not 18, the profit is 30 million. The profit is 30 million. 30 million minus 10. 30 minus 10, which is 3 million. So the profit is 3 million. 3 million divided by 5 years. That is 0.6 million. So that is 0.6 million. So our average profit is 0.6 million all over initial outlay, which is 10 million multiplied by 100. So in this case, we have what? We have 0.6 all over 10 times 100 equal to, what's our final answer? Please help me with your calculator here. Now we have 0.6 divided by 10 times 100. That is 6. That is 6%. That is 0.6 divided by 10. 0.6 divided by 10. That's 0.06 times 100. That is 6%. So it is 6%. So this is not correct. We have 6%. This is 0.6%. This is 0.6. Sorry, this is 0.6 million. As you can see, because our profit for the period, for the period is for the first year is 4, second year is 4, third year is 2, fourth year is 2. Last one is what? Is 1, making 13. Yes, making 13 million. So it's 13 million profit. So that is about that. What matters is your formula and you apply it properly. Average annual profit after tax divided by initial investment multiplied by 100. That is how we calculate accounting rate of return. Now the next one in the line is internal rate of return, and we are also using the same question. Now these are discounting factor. Why do we use this? When we want to calculate internal rate of return, there is something we used to do. And what is internal rate of return in itself? Internal rate of return is a discounting rate used by investor or use investment appraiser, which brings the cost of project and its future cash flow at par. The cost of project and the future outflow at what? At par. And it is obtained by trial and error method. Understand? So internal rate of return, it is the rate of return or discount rate of return that make the NPV of a project to be equal to 0, indicating that present value minus present value is equal to initial outlay. Remember, present value minus initial outlay is what you have as present net present value. So when the initial outlay and the present value is equal, that is when NPV equal to 0. And when we have a discount rate that gives us the NPV that is equal to 0, it means that we just let me say we just break even, if I was to put it that way. So that rate is what we call internal rate of return, the rate that makes the present value generated from an investment equal to its initial outlay. This is a kind of business that had no value to the shareholders' wealth, but it does not mean we can accept it. So we can accept this kind of project. It will be able to take care of all the costs. It's only that you've not had extra to the company, but you've not had cost to the company as well. So in the presence of nothing, we can do this type of business. So as I said, it is trial and error method we used to do. We have used 10% in the past. We have used 10% in the past as being the rate in the question, and we have a positive NPV. When we use 10%, we have what? We have positive NPV. Positive NPV of 0.4315. Okay, how is it possible positive NPV? Our NPV is equal to present value minus initial outlay, and our present value is what? Present value is equal to addition of present value is 10.4315. 3.6 plus 3.3 plus 1.5 plus 1.3 plus 0.629 give us this. So that's our present value. So present value is equal to 10.4315 minus initial outlay, which is 10 million. So we have our NPV to be equal to 0.4315. That is using 10%. But if you want to find out which one will give us 0, it means that we will assume a rate that is higher than 10%. A rate that is higher than 10% that will give us a negative net NPV value. After we have gotten the negative NPV value, we will now interpolate. Understand? We interpolate. So that is what brought us to the usage of what? Of 12% here. So we use 12% to find out what the present value when we use 12%. So the present value is 10.022. It is also, it gives us positive, although it is a minimal. Understand? So when we use 12%, we have, sorry, when we use 13%, not 12%, when we use 13%, when we use 30%, we have 9.8219 as our present value. So in this case, we have negative net present value. How does it look? We have we have NPV to be equal to present value minus initial outlay. Now, our present value now is 9.8219. Is it correct? Yes, 9.8219 minus 10 million, which is equal to minus 0.8219. So it is negative, or let's use bracket to be in accounting standard. It is negative. So once it's negative, we will now use trial and error method. Our trial and error method will be what? IRR is equal to small r plus positive NPV all over positive NPV minus negative NPV multiplied by difference between big rate minus small rate, where R is equal to small rate, that is rate with positive NPV, big R is equal to rate with negative NPV. With negative NPV. So this is the formula. What our small r is 10%. Now our IRR is equal to 10% plus positive NPV. Positive NPV is equal to 0. I remember it is 0.4315. 4315. 0.4315 all over 0.4315 minus negative NPV, which is 0.8219 multiplied by 13 minus 10. That's how it is. So in this case, we have 10 plus 0.4315, 0.4315 divided by, no, this is negative plus, it will now become 0.4315 plus 0.8219. That's what we had together, multiplied by multiply it by r big R minus small r, which is 3. So that is how we approach this question to find our internal rate of return. Now 0.4315, which is our MPV. Now 0.4315, which is our MPV, divided by 0.4315 plus 0.8219, close the bracket, is equal to, here we have, let's continue here. Okay, let me use this angle here to complete it. Don't let us use another page. We have 10 plus 0.3443 approximately, multiplied by what's different, 3%, multiplied by 3. So multiply by 3 times 3 is equal to 1.022 something. So we have our 10 plus 1.0330. So our IRR is equal to this plus this, that is 11,000,000.0337. So our MPV is equal to 11%, 10.0 something like that. So that's our MPV. That's our MPV. The prime value that we give, our IRR. Just follow the formula. Try to follow the formula. Oh, please beg your pardon. There's a little flaw here. Let me the correction first. Beg your pardon. We got our 12% also to generate what? Our 12% generate cash flow of positive cash flow of 10.224. Alright. So let's work between 12 and 13%. So when increased by, we have a negative value. What are we doing? Net present value 10.966. Alright, then 9 points. Okay, wait. You can still work it out. 10 minus 9.8219. That is 1.81. That is where the error is. Now, what we're saying is this. Look at this place. You have a mistake here, and the mistake is just, instead of the present value of using 30% is 0.1781. 0.1781. 178 what? 1781, not 8219. That is where the error is. Now that I've discovered the error, let's see. This is got it. It's 1781. 1781. So it gives us what? We have 10 plus 0.4315 all over 0.4315 plus 0.1781 times 13 minus 3 minus 10, which is 3. Let's just write 3 here. Now let's recalculate. Plus 0.4315. Okay, so it is equal to 10 plus 0.4315 all over 4.6096 times 3. Now 0.4315 divided by 0.6069 equal to 10 plus 4.7110 approximately. Now times 3. I multiply this by times 3. It gives us 2 points. So we have 10 plus 2.1329, which is equal to 12.139 approximately. So our internal rate of return, our IRR, is equal to 12.1313 approximately 1.33%. So that's our internal rate of return using interpolation method, which is also known as trial and error method. And the last one we want to do here, the last technique, is what we call profitability index. And we are talking of profitability index. Profitability index defines how much you will earn per dollar. How much you will do what? You will earn per dollar. And the present value of the cash flow minus, the present value of the cash flow is 10,000,04315 million, and investment is 10 million. So our MPV, our PI, profitability index, is equal to present value all over initial outlay. So our present value is 10.4315 all over 10, which is equal to £1.04315. That is that. And the rule is that if the PI is more than 1, the project should be accepted. That's that. Another way we calculate profitability index is by using net present value all over initial outlay as well, which is equal to net present value. Here we have 0.4315 all over 10 million. So our answer will be 0.4315 0.04315. And the rule here is this: if you use present value, your profitability then has to be greater than 1 for you to accept the project. But if you use net present value, your profitability index needs to be higher than 0 before you accept the project. So the both formula we use is indicating that the project is supposed to be accepted. That is about that. If there is any issue there, honorable students, don't hesitate to call on our line, or you can request to speak with the lecturer directly for more information. Thanks for your listening.